Hey there, everybody. I wanted to talk about annuities, that dirty word again. We're seeing more and more records constantly in the amount of production in the United States. And there's a significant reason for it. Mass acceptance is kind of happening, and it's very interesting how it's rolling out. We kind of thought it was going one way and it pivoted and went another way. So let's look at what's going on out there right now. So, in the headlines, 10th consecutive quarter of over 100 billion with a B dollars in sales. Okay, this is in the United States and this is individual investors. This doesn't include big hedge fund, the big money. Doesn't include that. This is just individual investors. So if that doesn't convince you that more and more people are using it, it should convince you that at least more advisors are understanding them and starting to utilize them in wealth management, in the legitimate wealth management world. Taking a little look at where the production is coming from really does clue you in to why this is happening. Okay, so fixed rate deferred annuities. Okay, they are known by several names: fixed annuities, MIGAs, multi-year guarantee annuities, and these fixed rate deferred annuities. 34 billion. They take the top spot. These are literally just CDs from insurance companies. Okay, so if you're afraid of annuities or think all annuities are bad because you have consumed the media that tells you it's bad, then take a look at those. They're the simplest out there. They are CDs from insurance companies, but they are better than CDs in a lot of ways. And I'll go through each of these and explain what they are. Fixed indexed annuities take the second spot, closely behind at $26.6 billion with a B. Another no risk type annuity, meaning no risk to your principal based on market performance or anything like that. When you go to sell it, you're in a defined surrender charge period. You don't sell it at an open market, which is what gives bonds their risk. Your risk in bonds is primarily from interest rate movements as opposed to being able to redeem them. Just tell the company I want my money back, right? And then the third, the making up the vast majority of the over 100 billion is the registered indexed linked annuities. And these have absolutely skyrocketed into third place. They have come from nowhere, and we know why. Then there's variable annuities that keep declining, and all the income annuity products, two or three different types of income annuities at $4.7 billion. So let's take a look at this. The reason this is happening is very simple. It's the need for diversification from bonds. It is so obvious. The first three that make up almost the whole 100 billion are simply bond replacements. That's all they are. That's what they are built for. They're to replace bonds. And for the first time, people are starting to realize it. Now, I realized it, 15 years ago, and the proof's in the pudding. Well, all of our client portfolios have diversified from bonds, and that certainly began a good 15 years ago when interest rates really were floundering around that little to no interest rate. And honestly, after 9/11, when Greenspan brought the federal funds rate down, I think it was to just below 4%, and just failed to bring them back up, waited till 2007, right before the 2008 crash, and started pushing them up. And that's a big part of what caused the crash. The banks weren't ready for it. The lending world wasn't ready for interest rates to go up, and it fell apart. So the reality is when we're in floundering interest rates, bonds become a big problem. And it's real simple. Think of a teeter-totter, right? So you've got interest rates at zero, which means you push that teeter-totter down and you got interest rates at zero. Well, the value of bonds are at the highest possible. So then when interest rates go up, you're going to lose value in those bonds. And when 2022 hit, we had stock market going down, interest rates going up. which caused bonds to go down. So you had stocks and bonds down a good 20% in 2022. And it was that big eye-opening moment for a lot of people that made them realize their bonds have done nothing for the last decade or so, and now they're losing money. Well, that doesn't do much for me in my portfolio. So the first reaction to interest rates being low was, well, just have less bonds, more stocks. Oh, then beta tested stocks started coming out. Let's do these volatility controlled mutual funds. And we started realizing those weren't really working very well either. And so now people want better, safe investments. And so CDs and now these three kinds of annuities that are so popular have become those bond replacements. So let's look at each of these. Those fixed rate annuities, MIGAs, multi-year guarantee annuities. I just scoured the market real quick to see what was out there right now. A little snapshot, 3-year guarantee at 5.4%, 5-year guarantee 5.75, simple interest 5.65, compound interest. That's the C and the S there. 7-year 5.95 simple interest, 5.5 compound, 10-year 5.75 compound. So at the height of interest rates last year or so, we were seeing 6% regularly, over 6% regularly. When you're in higher interest rates, you tend to want to lock in longer. Well, the problem with that is well, what if I need some of my money? If it's a bond, you can sell the bond. That's where the risk comes in. Well, with the fixed annuities, the fixed rate annuities out there, they give you predefined terms, and those predefined terms usually will tell you you have access to this money. You have access up to a certain amount, typically 10%. So each year, if you need some money, you can reach in and pull some money out as long as you limit it to 10% of the money. And this is a logical compromise here so the insurance company can go invest it. If it's 100% liquid, then it's just a money market account and you're going to be very limited on how much you can earn. They have to lock it in for a period of time so they can invest the money properly so they can pay you this interest. Historically, these have always had more interest. You could lock in better interest than CDs because CDs really specialized in short-term money. Okay, but we haven't really needed these. You got bonds and you got CDs. Nobody really walks into their insurance company and gets exposed to this type of stuff. And the dinner seminar sales events that are out there aren't going to sell these either because they don't have very big commissions. Anybody with an insurance license has access to these and can get these for you. Good advisors, well-rounded advisors, independent advisors utilize these regularly as bond replacements. They are very logically bond replacements. They're a fixed rate for a fixed period of time, and they don't have the market risk that bonds have. So, very obvious why these are the top ones out there. Billions and billions and billions a year. They're averaging over 100 billion a year for the last several years. That's enormous amount of these being written every year into portfolios, into individual portfolios like yours. Then there's the iteration of fixed indexed. And I'll be honest, here's the thing. Too much fixed rate creates a problem in a portfolio. What if we see lots of inflation and interest rates go back to 12%? Well, if you're locked into 6%, you thought it was good at the time. We hadn't seen over 6% in over a decade. And all of a sudden, 6% feels great. I want to lock in that 6%. And then all of a sudden, interest rates go to 12%. So I'm fine with some fixed rates, but the reality is you can't have that as your only investment. So fixed index becomes that alternative. That diversification is a better way to look at this. We now need to start diversifying our safe investments for different reasons than we diversify our stock portfolio. There's things like interest rate risk, right? That's different than market-based risk. Okay. So fixed indexed, instead of paying you a fixed interest rate for a fixed period of time, it pays you an interest rate based on how the stock market does. Okay. So in this case, I did pick some random years just to illustrate how they performed. So I think this is 21 and 22, and then this happens to be 25, I think, 2025. So S&P 500's dynamic interday. This is just a stock index that the S&P Standard and Poor's puts out and monitors, and an insurance company can then pay interest based on it. Okay. So in this case, the insurance company then says, okay, well, I'm going to cap it at 10 and a half. Okay. 10 and a half. That means annual point to point. So anniversary to anniversary. You hit that anniversary as the stock index up. The index is up 14.9%. Then they are obligated to pay you 10.5%. They capped the amount you could earn to 10.5% that year. Okay. Then when the stock market goes down, a fixed indexed annuity by regulation can't lose your money based on market turbulence. So when the stock market goes down, they just pay you nothing. Okay. Your base is protected, right? Stock market goes down, they can't take earnings away, they can't take the principal away from you. So you earn nothing that year. And then when it goes up 4.84, you're capped at 10 and a half, so you make the full 4.84. So that's an example of how these insurance companies pay interest in these fixed indexed. Now, the unique part about these fixed indexed annuities is they're all going to give you several ways to earn interest. So they'll give you a different index. This happens to also be Standard & Poor's multi-asset index with a risk control. So they come up with these fancy indices. A lot of these are used by the insurance companies, but you've got to understand how these indices work to make sure they're valid and going to produce a good rate of return for you, obviously. Well, this one highlights that the insurance company is not actually investing your money in these stock indices, right? So this S&P multi-asset in 2021 was only up 0.28%. Well, the insurance company says instead of a cap, I'm going to give you what we call a participation rate. A participation rate in this case is over 100%. There's your clue. Wait a second, that's too good to be true. How do you pay more than a stock index does? Well, it's very simple. These insurance companies are not investing your money in the stock index, just like a bank is not investing your CD money in CDs. I mean, think about that. That doesn't make any sense. The bank takes your money and invests it in credit card loans and auto loans and things like that. They earn more than what they have to pay you. So the insurance companies do this too. And it's real simple. They buy a block of corporate lending. Shows up on the books as bonds, but it's a little different than the bonds we get access to, right? So they're doing the corporate lending out there. They're like liquidity in the corporate lending world. So they lend their money out, making 7, 8, 9% interest on it. And then they take a tiny bit, 1, 2% of what you put in there, and they buy options on these stock indices. So that way, if the stock index rockets like it did in this case in 2025, it was up 10.3%. Well, if they have to pay 150% of that, that's 15% interest. That's more than they can make on their portfolio. So they execute that option. They buy the option to buy the index right here. They sell that option or execute that option right here. So they bought the index here, immediately sold it up here, take that profit and forward it on to you. That's how they're doing this. They're protecting when they have to pay you the double digits. The rest of the time, they're doing just fine. That's how they're doing this. So this one's a different type of index. This is more a stock index. This is a multi-asset, has bonds in it, has commodities in it, things like that. So it has other things in it. And so it's going to perform differently than you will find a typical stock index will perform. Okay. And that's why the insurance company will then pay 150. Their hedging cost is less expensive on an index like this with a volatility control and all that. And then they also offer fixed interest rates, which are never as good as these, MIGAs, these multi-year guarantee annuities, these CDs from the insurance companies. They're never as good as those, but the cool thing is you'll have a buffet of 10 different ways to earn interest, and you can change how you earn interest every single year. So this is really just a 1 year interest rate. And if you look at these interest rate, it's usually about the same as a 1 year CD. And you have it built it right into your contract. Every year you decide how you want to earn interest. You could sit back and earn a fixed rate all year this year if you want to, if you don't think the stock market's going to do well. You could get into the multi-asset index that has the bonds and it does well when interest rates are coming down. You could get into the stock index. It does fairly similarly to, say, the S&P 500. And you have lots of different calculations and ways to earn interest. This got a bad name for a while there, one because of the heavy sales of it instead of advising it. Okay, so dinner seminars and all that kind of stuff that goes on out there, these tend to get sold. But the reality is these have evolved and become a very viable option as a bond or bond fund replacement, because now a lot of these companies are actually guaranteeing their interest rates for the whole period, just like these fixed rates. So the fixed rate is guaranteed for all 3, 5, 7, or 10 years. Now you have the same thing available for these fixed index. It used to be a fixed index. You're locked in for 10, 12, 14 years, but they get to change their interest rates and you don't get to really earn anything. Well, now you have choices of 5, 7, and 10 years with guaranteed rates the whole term. And that gives you a lot more confidence in what you're able to earn in these things. So these have evolved and become an important part of portfolios, especially when replacing bonds and diversifying your safe portfolio. I hope that makes sense. That's why these are the second highest sellers. Again, selling over 100 billion of these a year into individual investment portfolios, a major part of portfolios going forward. And then the rise of the registered index linked. Well, one of the reasons annuities have such a bad name is because all the big box shops have fought against them because it takes money out of their assets under management that they're charging those management fees on. That is so important to their structure of their business. I don't want to have assets under management and then start plucking out big chunks and we're not charging fees on it anymore. These typically will not have fees from an advisor for any reason, and typically also do not have fees from the insurance company. Again, these fixed ones are built just like CDs at a bank. You don't see fees in the CDs at a bank. It's the same structure here. There's no fees in these usually. Same thing for the fixed index. They're built in that world of CDs where we're paying you what we can afford to pay you. There is no advisory fee out there. They will pay a commission to an insurance licensed individual, just like the bank will pay a commission to the kid in the bank that sells the CD. Registered index link annuities, though, are securities. They do have risk. And because they do have risk, they're not paying any commissions in these typically, and the advisor is taking their management fee out of there. So the big box shops now look at these and say, well, these can stay in assets under management. We can still charge our management fee in there. And it puts parameters on your risk, much like bonds do. If you didn't know bonds could go down in value, then you didn't understand investing. Bonds have always been able to go down in value. This just, you're not typically going to see a big 40% swing. It's going to be a lot more stable in general than the overall stock market day to day. And so that was the stabilizer you were putting in your portfolio. Well, this is going to predefine your ability to take risk. And so what you're going to see is upside caps or participation rates and downside caps or participation rates, or they call them buffers in there and things like that. So I showed you what a cap was with no risk. When we start looking at these with risk, you see numbers kind of like this right now. Now, this is much better than the last time I looked. Well, I look at them all the time, but the last time I seriously reviewed them when they were kind of first coming out, interest rates were lower and the caps were like 10% on the upside and 10% on the downside. You take away a fee and you scratch your head and go, there's no reason for this whatsoever. There was no reason for these things. Well, they're starting to get a little interesting. They're starting to get a little more competitive. So to keep this simple, I took some of the, there's some very convoluted, difficult ones out there. I took some of the more simple ones out there as examples. So cap with a buffer. Okay. So a buffer is saying the first 10% of a down market, you don't have to participate in. So if the market was only down 9%, you would lose nothing. But in this case, in 2022, the S&P 500 was down 19%. So your risk in here, you had a 10% buffer, you only took 9% risk. Okay, the buffer is the first 10% is on them, right? So that's all they did. And then they capped you at 20%. So if the market's up 26%, you earn 20. If it's up 16, you earn 16. Okay. That looks good. Eyeballing it, I would say, yeah, I think I could profit on this on average. I'd take on some risk to have better earnings, right? So then I look at it and say, okay, well, then there's something called a floor. So I took those same ones to show you what the floor was. The cap is lower, so your upside earning is less. But in this case, instead of the insurance company taking the first 10%, guess who's taking the first 10%? It's you. You get the first 10%, they get everything else. So if it's down 40%, you have 10% risk, they have the other 30. So there's the difference in terminology. It takes a little bit of a learning curve to understand all the moving parts. And I've typically not liked the annuity world, the more moving parts in one contract. I don't like that. I like something simple like just having a cap or just having a participation rate. But now we have to figure out all the rest of this. But the big caveat I still say when I go through and test all these and I look at back testing performance and seeing how these actually work, and I'll try to get out of the way here so you can see it a little bit better. But the reality is you now have a form of risk, but you're also going to have fees coming out, and you're going to find on average over 1% in fees. Because here's the problem, the advisor has to be able to take their management fee, but also the insurance company has to be given a reason to create the product. How are they going to make their money on this? And so typically they're going to have some form of a fee structure in there as well. Kind of like the variable annuities, national average is 3% in fees. So we're going to see fees in these things. And that's where, I'll leave it up to you whether this makes sense in your portfolio or not. But this is how they're being used. They're being used at the big box shops to give alternatives to the bond portfolios. These are very similar to structured notes. Okay, structured notes and registered index linked annuities are virtually the same thing, but I got news for you. So are fixed indexed annuities. They're all doing the same stuff. They're using options trading to create these fancy products. The thing is these fixed indexed annuities have been around longer and have already had their learning curve. They've honed it into an art. It's very clear and clean, defined. You have access to these. The big problem with most of the structured notes out there is you don't have access. It's a predetermined period of time and you have no access to the money. You want to try to sell it on the open market. If you can find somebody to buy it from you, sure, go for it. But the reality is these fixed indexed annuities, they have no risk to your principal or earnings based on market fluctuations. Now, they're always going to say just like bonds, just like CDs, just like anything, it's based on the claims paying ability of the insurance company. Okay, well, go look at the history of these insurance companies, the industry as a whole. They have reinsuring and endless amounts of backups and regulatory governance and audits and everything else. Um, you make your own judgment call. They're just as safe as anything gets, as a bond, as a bank CD. They have all the backups that you could possibly have out there. So these really, they're all built to be bond replacements. And I've long been an advocate of diversifying your safe investments. And right now, these tend to be the best safe investments out there. They really do. Look at the interest rates that you're able to get. These fixed indexed annuities, now that they offer the guaranteed rates the whole period, they've really redefined this category into a legitimate investing category. And that's why these sales, $81 billion in sales in just these three types of annuities. And there's not fancy, income producing 8% guaranteed growth, none of that crazy stuff they sell you on. These are being sold by mostly quote unquote legitimate advisors that are utilizing them properly in portfolios as bond replacements, as stabilizers, as diversified safe investment portfolio, safe and stable investment portfolio. Technically, this is a more stable investment, the registered index link. It's not safe. You have risk of loss based on stock market performance, whereas the fixed indexed and the fixed annuities out there, zero is your floor. That's the difference. Okay. They predefine how you're allowed to access it. As long as you play by the rules, there should be no fees in these two. There will be fees. You just know that this is going to continue to be an asset under management, which means they are going to be taking their fees out. Okay. I hope that helps you understand the landscape of what's going on out there in the annuity world. The vast majority of annuities being sold today are simply bond and bond fund replacements. And, my class of the month right now, the full classes I teach, I'm talking about inflation and protecting against inflation in retirement. It's a great class. Go to our nonprofit website, fpfeaz.org, and you'll see how that, the conversation about these types of annuities comes into play, because when you have a bond, it's the best anti-inflation hedge, meaning your value of your bonds will go down when we see inflation. That's what's going to happen. So you don't want to have your portfolio filled with bonds, especially in retirement. You can't have that as your only safe investment. And so I talk about these, but I talk about the whole structure of how you need to position yourself. And it's an hour-ish long class all about inflation and how to position yourself and how to make sure that you are able to compensate for inflation through your portfolio. So very important class, and topics like this, keeping your mind open and understanding the whole investing world, not which stock am I going to buy that's going to make me a millionaire. No, that's not retirement planning. Retirement is a much more difficult period of investing for people, and it's much more involved because now you're going from putting money in to taking money out. And tools like this make a huge difference in a portfolio. All right. Always happy to help. You can schedule a free meet and greet with me. We can chat about anything you want on yourinvestmentcounselor.com or even sesweb.net. You can jump on our company website as well. Our nonprofit organization is fpfeaz.org. I teach full form classes all around Arizona and live via Zoom, nation, worldwide, whatever you want to call it. And again, this month's class is inflation, all about inflation and protecting yourself in retirement. So jump on fpfeaz.org, smash that like button, and subscribe to our channel. I try to get some new stuff on every week. And thanks for joining us. We'll see you later. Have a good one. Bye now.